To start off with, I think it's very helpful to understand that every transaction that you enter is either on a revenue account or capital account. So revenue account is things that you do for profit. So all of, salary and wages, that's a revenue account. In terms of assets, if you're buying something with the intention to sell it quite quickly, that's going to be on revenue account as well. Whereas capital account is when you're buying it to hold it for the long term and to benefit off of that capital growth. And one of the key things that ATO looks at is intention when you purchased it. So I see a lot of questions come through of like, well, how long do I have to hold a property for it to be considered my main residence? Well, if the ATO has evidence that you are never going to live in it as your main residence, because of discussions that you've had with bankers or, the type of loan that you get or other stuff that's around, on the contract. So we'll work out putting some values to it. If we say that Sarah purchased a house for 500,000, but the value was 750 when she actually moved out of it, that 750 becomes the cost base. She sold it for 1.5 million. She had 30,000 of sale costs. That gets Sarah to a gross capital gain of 720,000. So again, just using that value when she moved out of it. That 720,000 is then split between the 6 years that it's exempt under the 6-year rule, and the 4 years that it was not exempt because we were outside of that 6-year period.